This is Macro Horizons, episode 367, Broadening Bearish Uncertainty, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 30th. And as the first quarter comes to a close, we'll look to the stands for a supportive wave. After all, the score is still 0-0 with Powell in the lead. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market was, once again, primarily focused on developments in the Middle East and the incoming headlines regarding strikes on Iran and the retaliatory actions. The biggest takeaway was Trump's decision to issue a 48-hour ultimatum on Saturday that expired on Monday evening. The ultimatum effectively said that if Iran didn't fully open the Strait of Hormuz, that the U.S. would hit and obliterate the power plants in Tehran. The president then subsequently extended that deadline. Now, as has been the case throughout March, we suspect that some significant developments will once again occur over the weekend, setting the market up for choppy price action on Monday morning. Thus far, the developments have tended to leave investors with the distinct impression that the war in the Middle East will not be measured in a matter of weeks, but rather months, which implies no near-term resolution and elevated energy prices. On the topic of elevated energy prices, the February print of import prices showed the largest increase since March of 2022. The headline increase was 1.3% on a monthly basis, more than double the 0.6% forecast. And interestingly, that wasn't an energy story. Ex-petroleum, the monthly gain was 1.2% compared to the 0.4% anticipated. Interestingly, when taking the inputs from import prices into consideration for core PCE estimates, we're still looking for a 0.4% gain in February. This is due largely to the fact that there was a drop in imported air passenger fares. Now, keeping in mind that this data preceded the war in Iran, it follows intuitively that if this is a departure point for inflation, that the Fed is going to struggle to make the case for normalizing rates in the near term. In this context, we'll also add that the March services PMI data disappointed, and it's worth highlighting that the report said specifically, average input costs rose at a sharp rate again, posting the largest monthly increase for 10 months and feeding through to the largest increase in average sales price since 2022. Higher prices were widely linked to the war-related spike in energy costs and tightening supply conditions. So, on net, we'll conclude that for the time being, the market seems justified in trading the war in Iran almost entirely from the perspective of an inflationary impulse.
Well, it was unsurprisingly another week defined by the war in the Middle East, and initially the tone was more risk-on than was assumed to be the case when we walked out last week, as Trump delayed his original ultimatum of striking Iran's energy infrastructure by 5 days, and that was interpreted by the market as a meaningful step toward a de-escalation, which was then followed by the reports of a 15-point peace plan that Washington has proposed in order to bring the conflict to an end, and, most importantly from the market's perspective, keep the Strait of Hormuz open and oil flowing. Obviously, the ensuing rally in treasuries was swift and dramatic, although the move toward lower yields has not fully retraced the repricing we've experienced, as there's still a great deal of uncertainty around what will ultimately come of the latest rhetoric out of Washington and what Tehran's response will be, with what that ultimately implies for oil prices.
And of course, as has been the case throughout the entirety of the geopolitical developments in the Middle East, uncertainty is the most consistent theme. What we worry about, in addition to how elevated energy costs will flow through to the real economy, is the degree to which this new area of uncertainty, i.e. war in the Middle East, will impact decision makers in the U.S., decision makers in terms of hiring managers and business leaders, decision makers in terms of consumers and households, and, of course, decision makers globally in terms of how to approach financial markets at this particular moment. Frankly, given the experience of the last 5 years in the market, it's not particularly surprising to see the Treasury market trade the spike in energy prices solely through the lens of forward inflationary implications, with little to no regard for what it could mean for corporate profitability, what it could mean for hiring, what it could mean for discretionary income on the household level. Eventually, these second-order implications will come to the foreground, but for the time being, the reaction function in financial markets has been risk-on versus risk-off, based solely on oil prices. It was also notable to see the response in the primary market for treasuries, specifically the $69 billion two-year auction that came on Tuesday and tailed 2.0 basis points. That's a significant tail that was accompanied by a low level of end-user or non-dealer participation. Said differently, the street had to underwrite a larger share of the two-year auction than is typically the case, and as a result, the auction tailed. Now, we are cautious against interpreting the auction results from a directional perspective and wouldn't suggest that a tailed auction portends higher rates going forward, if for no other reason than auction performance tends to reflect primarily the amount of volatility that there is in the market at any given moment, and given the price action seen early in the week, and frankly throughout much of March, it follows somewhat intuitively that investors wouldn't be particularly aggressive at the Treasury auctions. We're also not interpreting this as a sign that overseas buyers are stepping back from Treasuries as an asset class. Instead, the broader-based repricing is one that, as you point out, Ben, is a macro story, and it's a macro story based on oil. And while it might be nice to assume that at some point, sooner rather than later, we'll have a resolution to the conflict in the Middle East, a full and permanent reopening of the Strait of Hormuz, it seems more likely that signs of progress will be followed by reasons for caution for the foreseeable future.
And as we think about valuations, especially in the front end of the curve, your point about volatility, Ian, is especially important to consider in evaluating the result of the two-year auction. After all, almost universally in the conversations we've had with clients over the past few weeks, there's been a consensus around the attractiveness of the front end of the curve, and especially the two-year sector that touched 4% to start the week. Now, what 4% twos implies is not only that we've seen the last rate cut of this cycle, but also a reasonable probability that at some point in the not-too-distant future, we will again start to see rate hikes. Not only is this inconsistent with what we heard from Powell and subsequently Waller and Bowman, but it also underplays the other side of the inflationary impact from oil, which is that on the one hand, oil is primarily a headline inflation story, not to say there won't be some flow through to core goods, and on the other hand, as uncertainty and higher input costs flow through to consumption, ultimately the corporate sector, and what we're concerned about is the labor market, it's the feedback loop where higher energy prices weigh on growth, are a drag on GDP, and ultimately hurt the labor market. This feedback loop would advocate for more rate cuts, not less, and this is even before considering the incoming new management at the FOMC, once Kevin Warsh presumably takes the helm at some point in the middle part of the year, and he's already said he wants to get Fed funds closer to 3%, and especially now that we have this renewed risk facing the labor market and a more supply-driven and headline inflation risk, we doubt that higher oil prices in isolation are going to be enough to really change the incoming chair's idea about the appropriate level of policy rates.
That said, the chair only has one of the 12 votes, and he'll still need to get enough buy-in from the rest of the committee to restart the process of normalizing rates lower. We still maintain that the Fed will restart normalization and get policy rates back to 3% as a departure point for addressing the next leg of the cycle. What the war in Iran has done, it has made the timing of the first of these cuts much more challenging given all of the uncertainty. So, while the direction of travel remains toward lower policy rates, the unknowns emanating from the energy sector will continue to give the Fed pause, as it were, until either the conflict has been resolved or there's a more permanent solution to ensuring passage through the Strait of Hormuz.
And while obviously oil prices and the conflict in Iran have dominated client conversations this week, there's another lingering factor that continues to make the rounds both in the financial press and within conversations around the market more broadly. This is the growing worry surrounding private credit and the risk of a potentially more widespread issue around private lending and the relatively opaque data around this specific brand of leverage that the Fed has acknowledged they don't have a great deal of visibility into. Now, in and of itself, private credit obviously is not a significant issue that would warrant a larger risk-off response, but we are reminded that in higher volatility regimes, such as the one we've entered with the war in Iran, it's much easier for small cracks or uncertainties in the underlying financial system to become more severe as excess leverage has a way of working itself out of the system. Admittedly, we were surprised that Chair Powell didn't get a question about private credit markets in the press conference last week, but as another factor to consider in evaluating whether this increase in Treasury yields is ultimately a good buying opportunity, it's worth contemplating the other risks to risk asset valuations and the overall economy, aside from simply the reactions in the market around the next headline concerning the Strait of Hormuz. Now, we're not suggesting that a private credit blow-up is imminent or the risk thereof will soon start driving the broader narrative, but it is an important lingering consideration to keep in mind as we look at two-year yields that are still closer to 4% than 3.50.
It's also notable that 10-year yields are closer to 4% than 5%, and that demonstrates what we'll argue is a market that is cognizant of the upward pressure on realized inflation that at this point is frankly inevitable for the U.S. economy, compared to how this episode might create more significant demand for duration as the prospects for a more meaningful economic downturn increase the longer that the war goes on. Looking at 10-year break-evens, which have risen, obviously, since the conflict started, they're still relatively contained and in a far more benign range than what was in place during the 2022-2023 run-up in realized inflation and ratcheting higher in inflation expectations. So, said differently, the shape of the yield curve is consistent with a near-term increase in inflation that delays the Fed from cutting rates, but ultimately, it will likely translate into a downshift in the pace of economic growth going forward.
And further to that point, there's another aspect of how the Fed is evaluating the balance between the dual mandates, and that is the important tweak they made in the early part of last cycle to focus on not only realized inflation, but inflation expectations. Intentionally ambiguous, to be sure, but nonetheless, the fact that break-evens are relatively well contained and that the departure point from some of the more closely watched survey-based measures of inflation expectations have also been relatively benign means that even when we get a period of re-accelerating headline inflation, the fact that that will likely not flow through to a level reset of inflation expectations in a similar fashion to what we saw in 2021 and 2022 is another reason why we're skeptical the Fed is going to be too quick to change its policy bias. This is a stark difference from what we've seen and heard out of the ECB, which obviously has a different mandate and it's focused solely on inflation, and that's why as we watch the front end of the curve struggle globally, it's probably not out of the question we see rate hikes on the continent, even if it's still very unlikely that we see them in the US.
So, yet another example of the fact that things really are different on this side of the pond. What a difference a mandate makes. In the week ahead, we struggle to imagine that global financial markets are going to be able to deviate very far from trading the developments in the Middle East, even in the event of some type of collective agreement to reduce hostilities, there's still going to remain the open question about how much damage has been done to the oil and gas infrastructure and how long it will take to eventually get production back up to pre-war levels. And of course, any agreement at this stage will be viewed as temporary until proven otherwise. And it's with this backdrop that we approach the week's full data calendar with a degree of apprehension that it might not be as much of a tradable influence as might typically be the case. Nonetheless, on offer will be the ADP employment report for March, as well as March's non-farm payrolls and unemployment rate on Friday morning. Other data includes the JOLTS series for February, as well as ISM manufacturing and retail sales, as if there wasn't already enough information on the docket. At the end of the day, we anticipate that the greatest influence on the macro narrative will come from the unemployment rate. Here, the market is expecting a 4.4% print, which would represent no change from February. And recall, February's print on an unrounded basis was 0.44%. So we could easily see a slight upside surprise. But unless we see a 5 handle on the unemployment rate, there isn't much that's going to challenge the Fed's characterization of the employment market as having stabilized. When we consider that the consensus for headline payrolls is just 51,000, it's useful to put this in the context of the ongoing debate regarding what the correct level of break-even payrolls growth should be to keep the unemployment rate steady. Immigration reform, AI, the unanticipated drop in the labor force participation rate all have left both the market and monetary policy makers uncertain as to what to expect the new norm to be for payrolls growth. Recall that the Fed was quick to downplay the unanticipated and relatively sharp decline in headline payrolls and instead refocused the conversation on the employment rate. Within the other array of incoming economic data, we'll also take note of the performance of retail sales in February. One of our primary concerns as we enter the second quarter is that the pace of consumption could moderate given all of the uncertainties that have been introduced by the conflict in the Middle East, higher energy prices, higher fertilizer prices, which imply higher food prices later in the year, and all coalescing at a moment when the unemployment rate might be low in outright terms, but sentiment surrounding the labor market has erred on the side of weakness rather than a roaring rebound in 2026. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we reflect on the macro developments of the last month, all we can conclude is that March came in like a dove and out like a hawk. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.